Hey there, visionary business builders. In this episode, you're in for a real treat. I'm in conversation with my business partner, Mike Elwood. Mike is a seasoned corporate financier with over 40 years money market exposure. Now, Mike initially started out in NatWest in 1978, before some of us even started working, and formerly the managing director for almost 2 decades, a first stint with Royal Bank of Scotland and latterly with Santander before stepping down in 2018. At this point, we'd known each other for many years, having done a few deals together. We decided to buddy up to collectively bring our skills and expertise to support the growth of mid-market enterprises, particularly those looking to scale and succession plan. For the record, our first deal together was structuring £10 million acquisition with a family office on behalf of an experienced entrepreneur, followed by supporting a major retailer with a £100 million refinancing package, which consisted of 3 major banks and a revolving credit facility to support the operational cash flow. If that's piqued your interest, stay glued on, because in this episode, we'll be discussing some of the discussions we're having with some of our clients, the challenges of raising significant debt for the very first time, and where to turn when high street lenders no longer have an appetite to lend within your sector. We'll also be talking a bit about pricing for those of you interested in raising capital. Listeners, you're in for a masterclass on money markets from a seasoned professional with decades of experience at board level and the most creative capital structure thinker I happen to know. If you enjoy this episode, don't forget to subscribe to the Inner Circle Boardroom Visionary Business Builders. You'll find us on YouTube and LinkedIn. Hit the bell notification to stay in the loop. Now let's get this show on the road. Mike, welcome. You're in the hot seat for today. Let's start with highlighting some of the challenges of raising significant debt for the very first time, particularly for those in the mid-market.
Yeah, the first challenge I think that generally comes for companies in this space is actually just presenting themselves, thinking about how to present themselves. They generally don't have much of an idea about what the funder or bank is going to be looking for in terms of information, how they expect it to present it, who they expect to present. So the first piece is think really carefully about your company and make sure that you can articulate who you are and what you do and what's good about you really clearly in whatever materials you choose. And think about the information sources that you can provide that pulls it all together in one place for a potential funder to consider.
Can you give some examples where you've seen it work really well or not?
Where it works really well is when it's carefully structured to take the potential funder through a story. Often these are private businesses. You've got a founder who's really proud of his story, rightly. And what you want is to be able to go through the narrative of how the business came about, why it's there, but then to get into the detail of, well, who are its customers? Is the concentration? Can we explain why there might be concentration in the customer base? Who are the suppliers? Is there any key vulnerabilities around the supplier base? So giving people a real feel for what the daily challenges within the business are, so that from a funder's point of view, you can begin to address the risk for them. I've seen it done well by use of video alongside sort of presentational material, where videos might bring to life a factory or an outlet or whatever it might be, but some visuals I think can really help people get their minds around it and will bring the right sort of questions. You're never going to answer everything. So what you're trying to do is articulate who the company is, what it does, and then really stimulate a conversation. That's when it works best. You then also got to think about, well, who's going to do this for me? You know, it shouldn't be a one-man show. So you'll have the chief exec there, no doubt, to kind of give the overarching vision, but you probably want the finance director there to give a view on what the financials look like and bring that to life. You might think about whether the commercial director or sales director should be there, the ops director. Think about what the strengths are in your company, and then think about who needs to be there to tell that particular story. And when you get the materials right and you get the people right, then you get quite a compelling view of what the opportunity is for the number of funders that you should go into. And I would always say on this, start early. People leave it until it's often too late. If you're thinking about raising money, start to build relationships with people 12, 18 months before you're going to need it, and start to get people introduced. So start early on the journey, build the materials, and build the story and the narrative.
I want to stay on that time in the market piece because markets are constantly changing. And we know that because if we look at sort of what's happened the last few years with interest rates, the market's been very volatile. We've seen some players exit. You've had new players come into the market. Do you think there is a narrative around being too early, or do you get that timing right? Do you think you could give some scope around where we've done that quite well?
Yeah, the purpose of being early is to be able to really delve into and understand the story and explore the bits you might need to flush out. So are there some information gaps in the business? And if there are information gaps, then how do we get the evidence to plug those, the evidence that potential funder might need to see through? So that could be mentioned sales by customer, sales by geography, sales by product, whatever it is. But you might need more information behind that, and you need a little time to capture it. So the purpose of going early is to kind of identify those particular gaps. When we've been in the healthcare space, understanding the model that they're using, where the revenues are coming from. Is it private? Is it local authority? Actually building up a picture of what the revenue looks like, not just the number, but how it's made up and what the history looks like, how the history builds as well. And it's, you kind of use that information to show a potential lender the solidity and sustainability of that revenue stream. And the more stable and sustainable it is, the better the chance of being able to leverage the earnings of that business.
Another thing I wanted to touch on was the management time commitment and the role of the CEO in raising debt. Do you want to just cover that narrative a little bit more and just go a little bit deeper in some of the conversations that we've had?
So in my former life as a banker, I'd want to know what the CEO thinks of the business. I want to meet him. I want to understand her. I want them to understand what their vision is, how they bring it to life, what sort of person they are, how they see the risks in their business, how they're managing the growth. I want that story, but I don't expect them to lead all aspects of the fundraise. It should be kind of, this is my introduction to the business. This is how I see it. And then you've got other people can play their part. Finance director will obviously have quite a big part to play in it, but you do have to be really careful that they don't get bogged down in lots of information requests and putting forecast projections, sensitivities together, distracting them from the day job. They need to be able to balance the two and kind of get some help in to make sure they can deliver what's needed on time. And it's not just on time, it's also in a very easy to understand way. And anybody can submit lots of data. The key with this is being able to get the right metrics in a form that's easy to understand. Graphs using kind of visual representation of the numbers and the data is important. Think about the message you want to convey and how easy is it to pick it up. Because most people who are looking at this are very busy. Most firms have got as fewer people as they can manage with looking for opportunity. Therefore, when you pick up a presentation, you need to be able to get it really quickly, and you need to think, yeah, I like this. I can make this work, because everyone has time constraints. And if you don't get it and it's really complicated, you might just say, do you know what, I'm busy, I'll let this one go. So make sure that the visuals are good and people can grasp what's there really quickly.
I want to stay on that management time commitment. If you're fortunate, you've probably had someone from a corporate finance background who's got involved in fundraising. What's your view on a business who's looking to raise capital, especially when you've got markets that are moving constantly with new funds, lenders? The role of the FD in terms of having his finger on the pulse, and where do you see the opportunity for somebody who's coming in, and what qualities should the CEO be looking for?
The FD is probably your project manager of the fundraise, and so he needs to think about all aspects. And you mentioned that within the finance team, you need different skills, and different meetings will require different people. Funders will have the guy who's running the deal, but they might want to bring someone more senior out to meet the CEO, so they've got a kind of a sponsor within the organization, but they're not going to do the detail. They might have some people, so analysts who are going to help them put the paper together. Well, It might well be that there's a time where the FD has to bring some of his finance team together so they can run through some of the detail and the analysis and the sensitivity work that you need to do. He needs to understand who needs to be where and when in the various meetings to get the story across and have the right people putting the piece together. If you're taking external help, what is it you're looking for them to do, and what qualities do you want to look for in those people? I think the first bit is you want people who understand the funding market. So they understand who the players are. They understand that it's no longer just 4 or 5 high street banks. There's lots of debt funds around, lots of alternative lenders, lots of challenger banks, lots of product specialists. So you need somebody who understands the whole market and is able to put together the right funding package and then find the right sources for that. You also need someone who's capable, I think, of bringing stakeholders together. So these things generally will have 2, 3 key stakeholders, sometimes with differing agendas and objectives. And you need someone who's not going to rub people up the wrong way and is capable of bringing others together around a common objective to say, well, this is what we're here to try and do, and get them built around that. So I think those are probably the key skills. Whether you want to take in external help to do some of the data modeling or not depends what capacity you have in your team. That's another area that you can consider. But someone with experience of the market, someone who can bring people together is probably the core skills required.
Do you just want to share your views in terms of balancing growth with debt servicing?
If you're raising debt currently, you should do it with an idea of, okay, can I survive at this level? And actually, if rates were to go up 1 or 2%, I still manage. So you always want some kind of headroom in there. If rates fall, that's great. You've got lots more headroom, but I wouldn't build that into your thinking. More difficult 12 months ago when we weren't sure where rates were going to go, whether they were still going to increase or not. I know lots of people thought the roll was going to come down, but when you have inflation sticking around, high interest rates is one of the measures that governments can take to try and get that under control. And if you have higher rates for longer, a 5-year debt service plan can soon be underwater and challenged. And indeed, I've seen that in a number of cases I'm involved with, where it put real strain and pressure on a business because it always comes in different ways. Not only have you got the high cost of borrowing, but consumer confidence is dented. So sales are under pressure, margins are under pressure. So just at the time you need headroom to service, actually your business model's suffering as well. So right at the very beginning, make sure that you think about that and make sure that when you're looking at the debt service, that you've got enough headroom in for 1 or 2 unforeseen shocks.
As we know, lenders, they require collateral, which can be challenging for a growing business. What advice would you say to a business that may be struggling to raise capital at the moment?
First bit of advice would be, sit back and listen to why people have said no and see if you can understand it and what do you need to do about presenting your business or changing your business model to make it stronger. But assuming that you're confident and actually it's the lenders that you can't find to support you, it's then about looking across the market and thinking, right, where have I been looking and where do I need to go? So to give you an example, something I was involved in was a hospitality business coming out of COVID that had seen a real challenge in its cost base. Its revenue was pretty good because people were all going back into hospitality as you came out of COVID, but it had accumulated quite a bit of debt throughout the period. You went to the traditional banks, as we did at the time. They were happy to support, but they wanted to use a lot of the cash flow to reduce the debt in the next 2-3 years. In talking to the management team at that stage, I was kind of thinking, that's great, but we don't know if there's going to be another bout of COVID 6 months down the line, 18 months down the line, whatever. So we want to be able to use the cash. So I went out and found a debt fund, and they provided a 5-year facility at a fixed rate of interest with no amortization, slightly more expensive. But when you looked at the cash flows, the company was retaining more of its cash. So that particular debt provider, with the way that it structured its facilities, was right for that company at that point in time.
I also want to cover those that use traditional lenders and probably skeptical to look beyond for one reason or another. We've looked at cases where businesses have SPVs, and we've spoken about putting it more into a collective group. Do you want to talk a little bit about debt structures work better for businesses at different stages within their growth period, and where something like that would provide advantage, and some of the pros and cons?
Taking the particular one with SPVs, you can think in the care sector, you can think in the hospitality sector where people growing like to maybe keep, they don't want to risk the first unit, so they put the second unit in an SPV, and then they get used to using SPVs. But there comes a point where actually, if you put it all together as one group and you've got the cross-collateralization across the group, then the quality and strength of the assets and the quality and strength of the cash flow can achieve more by being together. Because guess what? A lender will see the diversity of protection there and think, I can probably do a little bit more against this, or I can do the same amount but a little bit cheaper, whichever way you look at it. But you will get the benefits of scale by bringing it together. And they often come together for various reasons. And it takes a little while to stand back and say, we might not be talking to the right people who are doing this by SPV all the time. Let's think about maybe some of the debt funds who traditionally start at a much higher number. And if you collectively put it all together, you might well find that you've got a facility that's better for you. And it shouldn't always be about price. People start with, can you find it cheaper? And the answer is, it's not whether you can find it cheaper, it's whether you can find a better facility with less stringent covenants, with a structure that amortizes less and leaves more cash to go to business. Whatever it is, information requirements that are easy for the FD to produce rather than onerous. But it's the whole package of stuff you could look at rather than just the one pricing element. That's the one people generally go to, and they often forget the fees involved. So they're not even comparing like with like.
I think sometimes the challenge with that mindset is it's a quite short-term view. Therefore, what it would probably indicate or highlight is the business is probably not thinking long-term or have a clear defined strategy. I just wanted your view on gaps and opportunities. How do you think chief exec should be approaching their debt structure? There are business leaders who've only been around the last 10 years.
So in running a business, you're never going to be an expert in managing money markets. The hedging strategies, you need to be successful there full-time. If you're running a mid-market business and you're looking for growth, then the answer is to look at where your plan is, look at what the growth is, look at what it costs to fund it, and against your forecast, have you got the headroom that you believe you need? Having determined that, then you say to yourselves, how exposed am I to a rising interest rates? And what can I do? And there are hedging instruments around that will allow you to cap and fix the rate of interest you're going to pay. Now, you might fix into something at a rate, maybe you fix in today at a rate of 4%, and rates fall to 2% within 12 months, and you think you've lost. But your model, your model can work at 4%, so you've protected that. And that's what really chief execs should be doing, is thinking, I've got a plan, I've got a vision for the business, I'm going to execute it, I've raised the money, I know what it costs, fix the cost of it. I can therefore deliver my plan based against that. The fact that rates might be cheaper a little bit isn't something you could get fixated with. It's an insurance cost. So, you kind of insure against things and it costs you a premium. That's the same.
Me and you always talk about, where do you turn when high street lenders are reluctant to lend within your sector? You want to talk about some of those options?
Anyone looking to raise money in this space at a significant level should generate a range of options, not just from a provider of one product, but actually other different ways to do this. Let's generate the options and let's evaluate the options. So, what do we mean by that? We're talking about the high street banks. And the thing with the high street banks is that we know that from a regulatory perspective, whether it's just kind of on lending and capital, or whether it's on operational assets, whether it's on reputation, that their appetite is becoming more and more conservative. And that means that they're not able to support a lot of the growing businesses. They will tell you different, but that's the reality. And I've witnessed it over 10 years at least, if not more. So what you have alongside that is a whole host of challenger banks who do the same thing as the banks, but take a little bit more risk, charge a little bit more money. So the margin will be a bit more from the challenger banks, but you're taking a higher risk. Presumably that's because you're growing your business. So if you're generating capital value for yourself, the extra cost might well be worth doing. So they're the two that most people will be aware of. I did mention earlier on about debt funds, real estate debt fund, but there are cash flow debt funds out there as well who have built up businesses, began a lot of it by backing leveraged buyouts with private equity, where the banks were moving away from providing debt for those because they felt it a little bit. It was cash flow based, it was riskier. So a lot of debt funds arrived. There's more than 50 of them now. There's lots of them in the UK providing. And that's kind of moved on to private credit and funds that will look at general corporate transactions from a debt fund perspective. And they have less regulatory capital burdens on them. So they're able to be a bit more flexible in structure, a bit more aggressive with their appetite. They will charge a bit for it. But again, if you can use that to grow your business, then that might well work. And then it's then looking at things like asset finance, invoice finance, stock finance, sale finance. There's lots of different products for different growing companies that you can look around the fringes. They're generally more difficult to combine with other sources. So if those products aren't generating all that you need, it's going to be quite hard to carve those assets out and put them together with a real estate fund or a cash flow fund. So they might work for you, but generally they probably don't quite deliver enough, other than maybe the really early stages of growth. So there's lots of different sources out there. As I say, lots of different price points in that. You're going to pay a bit more, but look at the overall development of your business, what value you can create for it, then assess the cost and evaluate all of the options and choose which works best for you.
I know we've covered pricing already a little bit, but for those of watching and are interested in refinancing and raising significant capital, what are some of the mindset shifts that leaders often struggle to make when approaching their debt structure model?
I think if they've been with the well-known high street bank, they find it hard to break out of that mindset. And when they look at the pricing of some of the other players around, that kind of reinforces their view. Instead of looking at the other way around and say, but how restrictive is my current debt facility, even though it's a bit cheaper, how restrictive on what I want to do with the business is it? And actually, do I need a debt facility that works for the business better? And I've mentioned before, is that the covenant package? Is it the information requirements? Is it the due diligence requirements? There's lots of components go into putting the facility together, and not only putting it together, but maintaining it and running with it after you've done the deal. Make sure that it works for your business rather than you working for the provider. Because if you're having to provide lots of information every month, lots of course go through it, no headroom in the covenant, so you're always looking for waivers on the covenants, you're going to spend an awful lot of time managing the funding line. Whereas maybe there's someone out there who will provide something that's a bit more tailored to your business as a structure and covenant that kind of work with your annual cash flows, such that actually you don't have to spend as much time keeping them up to date, and you can get on and manage your business, and that's where you'll create the value.
So, Mike, you're sitting on a number of boards. You're acting as chairman, non-exec director, in an advisory capacity for structuring debt models, raising capital. You're always in conversations with the money market. And with your finger on the pulse, do you just want to give a bit of a synopsis of the type of conversations you're having?
I think it's still early days of a new government in the UK. The last 2 years have been jittery, would be the word. Confidence has been pretty low. Kind of ability to look forward has been difficult because we've had so much change, been no stability at all. We've now moved into kind of a new time. The big impact is around budget, and it's probably more around capital gains tax and entrepreneurs relief, how it's going to impact things there. But it's about trying to create the platform of stability for people to plan from. And I don't think we're quite there. So it's still a difficult time. Not sure where rates are headed. It looks like they're probably coming down, but nobody really knows at the moment. So still uncertain. I think still a challenge.
What have we not spoken about that we probably should be speaking about?
I think we've covered most. We've kind of covered the alternative routes to find your debt and your capital, which I think is one of the key these days. There's lots more around, so think about it. We've talked about don't just focus on price, think about all the other components of the debt package. But right at the beginning of the journey, the bit is about how am I going to present my company? Who's going to do it for me? And how do I do it really well? And I think, the advice I would give people is if you get that bit right early on, it's difficult to understand the positive impression that gives to prospective lenders. They walk away with a really positive impression of the management of the business, the sector that it's in, and think, yeah, I like that. Because we all like things easy. We all like things easy. So if something comes in, you think, really good quality, I'm going to put my time into trying to deliver that one. You get a momentum behind it, and I think that's good. Thinking about it and not taking it for granted that people should know about the company or the sector. Show them that you've thought about all the aspects that will affect them, how you've addressed it, how you've mitigated risk, and you'll get a level of confidence that sees them want to win your business.
Having been on the other side, leading to prominent financial institutions, when business is presenting to you, is there anything that you've seen that you've just thought this is a disaster, and any reason why?
The biggest disasters are usually when founders, chief execs, management teams really don't think you should be asking any questions. They really don't like challenging questions. The best management teams understand why you're asking the question and have an answer for it. Where it goes wrong is when people get defensive and really don't want to tell you what they're thinking and think you should just go off the paper that's in front of you. And there's no rapport. You're not building any rapport. You're not building any confidence. And if your business is strong enough, you might get away with it. But actually, looking at this as I'm going to help these guys go and get the money for me. Because nobody's got their own money, or very few people have got their own money. They've all got to go to somebody else to get the money. Therefore, they've got to have a convincing story. So if you're at the front end of this as the customer, make it as easy as you can for them. And you should have it. You should have the information they're looking for, and that demonstrates that the business is properly set up. Where it goes wrong is when people are just a closed book and won't share information, won't tell you what's going on. That makes it really, really difficult.
How important are valuations in your view when you're trying to raise money? There have been some crazy valuations, and the market's at a point at the moment where people want to exit and the market doesn't marry up with what their view is.
Valuations kind of set what the funding requirement is. And any debt provider is going to look at, how much equity is needed. And the difficulty when valuations are high is you need more equity to make it work at a time when people are looking to get a better return on their equity. And if you put too much of it in, it's hard to get a good return. So they want the debt to leverage you to help them. And you get into the triangle of trying to make all of that work. If you have a more realistic valuation, it's easy to make it work, but somebody loses out. So it's, what is the asset that you're funding? And when I say asset, I mean company or assets, and how in demand is it? And that will determine who pays what. But it comes back sometimes to who the buyer is. So, we know that private equity can move in to buy things. Listed companies will find that more difficult. They'll need to kind of go back to market for more equity. They generally don't take as much leverage as a private equity company. It's the mix of the valuation and the funding requirements that kind of get determined by all of that, and they'll fluctuate. And of course, if rates are higher, which they have been, then the cost of debt is higher and you can afford less of it. So the impact in valuations is you need more equity or the valuation has to come down. In a falling market of interest rates, you can probably begin to put a little bit more debt into things. And generally what will happen then is valuations will start to go up again.
Folks, that's all for today's episode. If you have any questions regarding the money markets or a deal structure you're working on that perhaps you'd like some input, we'll include our email addresses below. Don't hesitate to reach out to myself or Mike. If you found this valuable, you're in for a treat because we have a treasure trove of interviews with other visionary business builders, all sharing their hard-earned insights. Don't miss out on the new releases. Subscribe to the Inner Circle Boardroom Visionary Business Builders. You'll find us on YouTube and LinkedIn. Hit the bell notification to stay in the loop for our next deep dive with a visionary business builder. Till next time, keep aiming high and building smart.